I'm going to talk more about the capital markets and what we're seeing in mergers and acquisitions, and really talk about the three sectors that we focus on. In the Gulf Star Group, we do a lot of our business is selling companies. A lot of times, as with state services, the principals take some money off the table and are continuing to develop it. But our business is related to service businesses that are around the oil and gas business, around pipeline services, around petrochemical and refining services. I think Will might talk about, the actual oil and gas companies, but we're focused more on the service businesses. When you look at the where we are today, I think we're very fortunate. We're tremendously fortunate to be in Houston, Texas, but as this chart shows, we're progressing back to account where I think we're going to get back up to 2007, 2008 levels, which I didn't think we were going to hit for a long time after 2009. I think a lot of the transactions that happened here in 2009 probably were transactions that were already in some form or fashion in play in 2008 that got delayed into 2009 because of the just the total economic downturn that we had. But today you have a large universe of public companies with buyers who are flush with cash. Their stocks are trading at attractive multiples. It makes it a very good market for sellers who want to access that. Additionally, you have a lot of sellers who, because of concerns about what's going to happen with tax rates, as well as you have a whole segment of the baby boomer population that wants to get liquidity. I think that there's a lot of buyers that are going to be out in the market this year. There's a substantial amount of uninvested private equity capital that's on the sidelines that we're going to just look at and see what the overhang is. And then the third thing that I think is now really having as much of an impact as anything is that the lenders are finally becoming relatively aggressive again. We're getting a return to some cash flow based lending. Although when you get into the actual bank market, where you have huge regulatory pressure, it is much more difficult, I think, to do the borrowing. And then the high yield market is very active still. This next slide shows what the amount of what I call the private equity overhang is. In the periods of 2007, 2008, there was a lot of capital raised in the private equity market. And then you had a slowdown in the level of spending, and you have about, in our estimation, about $435 billion remaining to be invested. These funds are mostly partnerships that have raised money. They have a period of time that they have to invest the capital. They're very smart buyers, but today is a very good time frame because of the ability to leverage acquisitions at low interest rates historically. So I think you're going to see a lot of this money be spent, and it has to be spent or there are issues to deal with on the just their partnerships. If you look at what trends are, we've talked about a number of these things in the oil field market. Number one, your shale plays generally require more equipment. You're drilling a lot more wells to create the same level of production if you had a huge find from a conventional standpoint, but the shale plays are the ones that have the economics associated with them. So they require both the horizontal drilling plus, as we've talked about here, the fracking equipment has to go there and it has to be part of the whole thing. You have people you have companies that have come in here that are spending so much money, they're already committed into the developing the resources, and that's going to require more equipment and more fracking. You have an interesting dynamic today in just the price that we're going to get into of gas versus oil, and I think that that's going to create some dislocations in the business, but the oil economics are so compelling if oil stays at its current level that they can probably absorb what you're going to move out of the gas producing areas. We've had a lot of talk here about fracking. I believe what the experts have said today, but it's something that it keeps getting attacked in the public marketplace, and it gets attacked from a standpoint of, I think, disclosure of the chemicals is the most minor of the issues. I think the issue of what you're going to do with groundwater, and if they start putting regulations around that, I think it could slow down the process. Plus, they're talking about additional regulatory filings. That in itself will slow down the process of doing fracking. So I think that the most important thing for the level of activity is that fracking continues here, and I do think you're seeing more and more technologies come into the fracking that are helping it. The next factor is international stability. I mean, if we have a real situation in Iran, I think it's going to be, I don't know what the repercussions are going to be here. I think economically it could be a really negative impact. Even with oil prices going up, that's not going to be good for the economy. The next thing is coal versus gas. I mean, Tudor Pickering's written some very good articles, but I think you're at a point now where gas should be replacing coal. I think new power facilities, it's overwhelming, I would think, to go to a gas-fired power plant. And I don't know if you're going to, it's going to be interesting if you have coal plants shut down and gas plants brought on. And lastly, just onshore versus offshore, state services. I mean, we've had very good companies. It's a wonderful company, but its business was primarily building production platforms on the shelf in the Gulf of Mexico, which was not helped a lot by the Macondo spill. They are doing quite well now, and you're seeing some kind of development, but I think much more of the development offshore is either deep offshore or it's development drilling. Here's just a slide that shows the divergence between oil and natural gas prices, with both of them hitting a peak in the 2008 time frame. But as you can see, I mean, with gas where it is today, the economics just aren't there for drilling for dry gas. You're going to start seeing, you're already seeing rigs moving out of the gas area. Oil dipped down you know, in 2009, but it's really been able to trade in at least a $80 to $110 range, which is excellent. This is a slide that just shows you, this is from Energy 21's public information, which happens to be a producer in the Gulf of Mexico, where you have had very high prices because it's not bottlenecked by Oklahoma. So they're getting Brent pricing, and this is just the difference that you've had between the oil-gas price relationship from September of 2010 to December 2011. You've gone from a 16.4 relationship on price to almost 34 times, which is just shows you the economics are in the oil. These are the U.S. oil and gas rig counts, and the top one shows gas. As you can see how many rigs we had drilling for gas, it's interesting, and then the bottom one is for oil, and oil's come up now, and you have more rigs drilling for oil than you have for gas. And the bottom one just shows the decline in the gas rigs and the increase in the oil rigs. I think some of that equipment is going to go from the oil producing areas to the from the gas producing areas to the oil producing areas. But I read the other day that Baker Hughes said that gas rigs running in the domestic United States were at their lowest level in 10 years. And this is a chart that came out of some JP Morgan research, but it just shows the increase in horsepower in fracking equipment that's moving into the market. Now you're having, in many instances, drilling rigs where operators have contracted for a certain number of drilling rigs. They're just marching down methodically and drilling on it, on the wells, and they're having frac crews follow them. I mean, the frac crews in many instances are the issue that's causing the, it can be the bottleneck. Talking a little bit about pipeline services, and then I'm going to just circle back on the capital market side. You're beginning to see the XL or Keystone pipeline being constructed from the Gulf Coast to Oklahoma. Even without the presidential approval, they're starting to build the pipeline. They have significant costs incurred in building equipment for this pipeline. And I agree with David. I don't see how we have not approved the pipeline yet. I think ultimately it will be approved, but this is a 30-inch line, which is one of the, which is a big pipeline diameter project and is very good for the companies providing services. You probably have, I have here 30 other projects, it may be more than that are 50,000 to 200,000 barrels per day. A lot of pipelines from the Eagle Ford Shale, a lot of pipelines from the Bakken Three Forks area. These pipelines are going to come down here. You're going to see some pipelines bringing the liquids from the Marcellus area. I mean, some of this is not maybe taken place yet, but right now they're loading Bakken oil up on trains and bringing it down here. And you have a $10 perhaps differential from the basin to get it down here. And if you compare the price that they're getting up in the Bakken with the price that we're getting in the Gulf of Mexico being Brent, it's an astounding difference. It's over $20 a barrel. Lastly, you have aging pipeline infrastructure. You have a lot of questions that the government has focused on, are the pipelines safe? We've had some explosions. I think you're going to see a lot of hydrostat testing here, and you're going to have work that's going to be done on existing pipeline infrastructure. So you put all these factors together, you talk about even before you have the XL pipeline approved, and this market is going to be very active for at least the foreseeable future. Lastly, the low natural gas prices have had a great impact on petrochemical complex economics. I think this is the manufacturing sector in the United States where we have the biggest advantage over other countries. We have all the infrastructure here, very big plants. We're beginning to have capacity additions coming on. You have some plants, the Dow plant, which is an ethylene plant. They're bringing back on a plant that had been where they're running half of it and they'd been idled, and they're bringing it back on because the economics are here. This is the best place in the world right now to produce these, to produce petrochemicals. I think it's humorous sometimes to hear about how we're going to go to wind power and solar. Everybody's focused on electricity, but all the plastics, all the things that we make from petroleum, I mean, there's a huge industry here that we need to have the petroleum resources. And lastly, there had been a lot of deferred maintenance in this area, so you're beginning to see, companies that do service work around the petrochemical and refining area are beginning to have a lot of activity. So translating that into what that means for Houston and what it means for our marketplace is, number one, we're as busy as we've ever been before, and we're working in the middle market. I mean, we're not working with the giant companies. Our companies are usually have transaction values of $25 to $300 million, but there are a lot of companies like that, and there's a very active marketplace both from strategic buyers for those companies as well as private equity buyers to provide growth capital for the initiatives that are needed to bring additional equipment and service into the marketplace, to just the liquidity events that many people are looking for today. So I think we're seeing cash flow lending usually on companies with 10 million in EBITDA and above, where it used to be 2 times EBITDA, now it's 3 times. If you get over 20 million in EBITDA, it may be 4 times on the senior debt side, and then you're getting additional capacity from subordinated debt. That ability to leverage the companies is driving up the multiples from a transaction price model. So there's a lot of activity in the market. I think it's a very good time to be in our business here in Houston, Texas. And with that, I'm going to pass it along to Will.